Hey, good morning, everybody. Happy Tuesday. Hope everybody's doing well, no matter where you are, working, listening to this in the office or at home. Appreciate you tuning in. Got a couple money supply charts here. Little update with the United States M3 money supply and how to use it. So let me pull up some screens here. Whoops, that's not going to work, is it? Let me fix that really quick. Okay. Now, pull up a chart. So, shown this a few times. And again, this is just the United States. As for how dominant the United States is in the world, it's often a question for not just monetary policy, but diplomacy, fiscal policy. You got to look at the largest money supply to see where we are, okay? And it's not M2, it's M3. Now, unfortunately, the Federal Reserve stopped publishing M3 here in 2006, February. And they stopped publishing it precisely, although they didn't say it, but probably because they were running hot on M3 and they were losing control. Repos were a problem. Repurchase agreements were a problem in the global financial crisis, and this was now 2 years ahead of the global financial crisis. They stopped publishing. And they also probably lost control of the Eurodollar market at this point. Eurodollars are basically offshore dollars. So Caribbean banks, European banks, the name Eurodollars is just a hangover from World War II, post-World War II, but it's all offshore dollars. It can be dollars in Japan, dollars in Argentina. The physical currency is always the physical currency, all right? And that's here. It's included in M1, all right, which is here. That chart gets messed up when I tap on it, so let me try it again. So M1, as I'm drawing here, number one, includes physical currency. All right, so it's up to $9 trillion. Only about 2.2 is in physical currency. That's worldwide, it goes around the world, okay? It's in there, actually, M0 as well, so I could click on and off there. You see the 0 right where my cursor is on. The arrow is right on 0. $2.2 trillion, $2.3 trillion. But that's not all the dollar deposits in the world. Of course, you got to go up the stack, M1, M2, M3. M1 includes demand deposits. M2 includes less liquid retail deposits like savings deposits, time deposits, money market funds for retail. And M3 is institutional money market funds, institutional time deposits, repurchase agreements, and Eurodollars. I have not figured out a way to calculate Eurodollars yet. Neither has anybody else, but not even a real good proxy. Any bank in any country can offer a dollar-denominated deposit to its customers, and they've just created Eurodollars. They've created dollar-denominated accounts that are outside the control of the Federal Reserve. It's probably quite a big number. Probably in the tens of trillions. There's been various estimates. but I'm taking it out. When they stopped publishing M3 in 2006, the Eurodollar component that they showed was like a couple hundred billion, which was even then probably wrong. So the point of just going through this with you guys is to show that measuring money is tricky. It's not easy. It's more of an art than a science. And the institution that's supposed to have control of the money supply themselves, the Federal Reserve, hasn't done so since 2006. So anyway, this is a backwards calculated M3 without Eurodollars. Okay, so it does have repurchase agreements. It does have time deposits, money market funds at all levels. That's the light green shaded area. Okay, the total, as you see it, is 35.4 trillion. Another problem, as always, with this exhibit is this is only as of December. This is a very, very lagging indicator. Federal Reserve publishes some of this data monthly, some of this data quarterly, not on time. And so even my monetary base exhibit, which I do quarterly, that at least is based on usually monthly, although not always. Sometimes there's central banks that only do quarterly, but mostly monthly calculations and updates on the money supply itself. So the monetary base in the United States' case is what you see, that bank reserves plus vault cash, which is $3.3 trillion. That's a negative because that's only in banks. And then the M0 figure, which is 2.27 trillion. Add those up, you get 5.6 trillion dollars. That's the monetary base as of the United States as of year-end 2024. If you want to see how that changes over time, as well as how M3 has changed over time, let's first take this M1, all right, which is the number 1 here, all right, which again is just all demand deposits, the most liquid type of bank deposits, plus M0. Okay, M0 is included in the M1 figure. Okay, so you get about 10 trillion as of December 2024. Let's take all that divided by the bank reserves. The bank reserves, again, in the black, plus a little bit of vault cash. The vault cash is very, very small. Let's do the multiple. The thing about the money supply is, though it's interesting to calculate, and it certainly is a crucial component in the economy, it's not necessarily indicative or shows us when or how a crisis would occur. I mean, who could have imagined that we would have had this money supply chugging along for 50 years? Okay, according to this data, the Federal Reserve starts most of their money supply data in 1959. So as you can see here, this is that typical 10x multiple. So what the bank holds in reserve against the deposits that they issue is usually something like 10%. You can see that the M1 money supply is 9 or 10 times bank reserves. Right? If you zoom in to say here, the bank reserves are very, very small, right? I mean, look at the bank reserves. It's the fifth line here on the tooltip. 90 billion, 92 billion, 99 billion, $100 billion only. Whereas M1 is 1.6 trillion, so on and so forth. So the point is, everything would have been better had Bernanke not bailed out all the mortgage-backed securities, but he did. We would have been back at it, had a healthier economy immediately. Instead, he chose to change the game entirely, and so now banks have way more reserves than they ever used to have. That's, again, the black shaded area on the bottom. It's their reserve to the money supply. And so now the multiple has gone from 9, 10, 11x down to 1x. All right, it's creeping up now, 2.3x. It's actually more normalizing. Will it continue to normalize? Nobody knows. We've had in the US, QE 1, 2, 3. Right, you see the bank reserves are increasing here 3 times. QE 1, 2, 3. Getting bank reserves up to $2.6 trillion by the time QE 3 was over. And remember, bank reserves were not even 100 billion before the crisis. So it was a completely different world that was created. And though the inside liquidity or banking money liquidity, which can be found in M1, M2, M3, did not rise as much, these multiples are just way out of whack compared to how the system used to be. And they always say they want to normalize, right? So here's the multiple was creeping up here in 2019 before the repo crisis here. Got up to 2. Got up to 2x, right? And then COVID happened, but really COVID was masking more money printing that might have occurred regardless. Probably wouldn't have occurred as drastic, certainly would have been as drastic as COVID's money printing called for, or at least they thought they had to do. But you see this little multiple, this black line is creeping up here. They're trying to normalize. They're taking the bank reserves down and still printing money. But then when COVID hits, everything just goes way out of whack. So it went back down, 1x, nearly 1x, and then creeped up again as the public was also using a lot of this newly printed money, which is denoted in this M1 here. Okay, so stimulus, bailouts, wasn't just M0 cash that they were creating. The Federal Reserve was directly, in conjunction with the Treasury, was directly monetizing new bonds, new debt issued by the government into the money supply. So money supply really jumped here as far as an M1 goes, right? It was 5 trillion before the crisis, before COVID. After the COVID now, it's 10 trillion. And then the other thing to look out for is this notice how M3, let's take off some stuff here just to show you exactly what I'm looking for. Notice how M3 is increasing relative to M1. And so the spread used to be, just roughly here, 5 to 1 in 1995. In 2008, it's close to 15 to 1. All right. And spread has come down after the global financial crisis. Here you can see again it's 5 to 1 roughly in 2017, but now it's creeping up again. Or is it? No, the M1 was also increased, so the spread didn't actually increase, but right here you can see it's creeping up again. So like here, it's still 3 to 1. Right? M3 divided by M1. But it's creeping up. Okay, and there's more, that's mostly repos are going back into the system after being in the Federal Reserve's balance sheet, which you can see here. Whoops. Here. All right, so you see this the black shaded area on the bottom and the gray shaded area. The Federal Reserve was kind of bailing out the repo market. These are basically just reserves for non-banks. And now they're letting it go back into the system. So that gray shaded area is falling for the Federal Reserve, but it's rising for the money supply. And you can see that happened here again before the global financial crisis. Again, does that portend a crisis in the next few months? I have no idea. It's just something to keep an eye on. Then if you look at this multiple, okay, so this is M3 now. Divided by the total Fed balance sheet. And the reason you include the total Fed balance sheet is because M3 itself includes all of this liquidity in the chart. Okay, before, demand deposits only included the green area, right, and divided by the bank reserves. But now we need to do total Fed liabilities, because that's M3, and just see how that multiple looks up. Again, this one kind of shows like a warning sign, like maybe this is a reason why the Federal Reserve stopped publishing M3 in 2006, because you see historically it's just been creeping up. And before the global financial crisis, it was at an all-time high. And then with Ben Bernanke's intervention, just crashed this thing way down to levels that actually were never seen. Back in 1959, it was 25x. The M3 money supply divided by the total Fed liabilities. 25x. Now, you crash it down to like 6. Just a totally different world. You get weird things like around the globe, you're getting negative interest rates. The Federal Reserve never had negative interest rates, but had all-time low interest rates. Cautious investors, people demanding safety, and also a lot of liquidity. So it's just a wild swing in the numbers. You saw they were trying to normalize it. It's the same story, right, as what happened with M1 versus bank reserves, but they're trying to normalize it here from 2014 to the crisis. And then the crisis occurs, COVID occurs, and they have to push it again. So one has to ask themselves, is this time different? Are they going to be able to normalize this, maybe push this number back up to, let's say, 1959 level multiples? We're only at an 8.5x M3 money divided by total Fed balance sheet. That's historically still way low. What happens when M3 gets back to 25 times the Fed balance sheet? Is that going to be all right? Is it too much money in the system, too much inflation? Also, how do interest rates play in this picture? Can't tell you, like groundbreaking insights, but I can tell you that you can clearly see the system has been completely abnormal for the last 15 years. And they're going to just keep trying to tinker with it best they can to bail out their friends, mostly. It's typically how it goes. The question is how it will be for the average person. So here's another chart I wanted to show here. Let's take the multiple off. This is the same M3, okay, but I'm going to compare it now to the United States debt. Okay, so M3 now is dark color. All right, so it was light here. It's the light green. Here's dark green. Same M3, only unfortunately going to the end of 2024 still. All right, now let's overlay the debt. Debt's going to be in a light green now, and see how that looks. Okay, so usually M3 is even bigger than the debt, but not always. As we can see here, M3 starts to be smaller than the debt. So let's look how this looks over time. This is a linear relationship. This is 1-to-1. This is not a power relationship. It's not an exponential relationship. You can see by this ratio, it's if we were going to draw a trend line, it would be a straight line on linear scale. It's a 1-to-1 relationship. Again, not completely helpful in trying to determine the future or even determine a crisis. but we are moving to an extreme on this chart. Okay, so let's look at the extremes. First of all, extreme on the top end happened at the start of the chart. Okay, where what does this mean? All right, it's debt divided by M3. I always hate how that redraws. Let me redraw that again so you can see the numbers more clear. So this is a slightly different metric we're going to look at now. Here's an extreme, about 1-to-1 back in 1959, fell down to the end of the Vietnam War, 47%. And by the way, if you recall on the other chart that I show, which I can pull up, this is also when the Federal Reserve owned the most of the United States debt was during this point, 1975, which is also the same time that debt was the lowest level against M3. So that's kind of interesting. Then we go back. Another extreme happened in 1995. Go back to nearly 1-to-1 relationship. Trended down again towards the global financial crisis, which is basically an extreme to the downside. It wasn't as low as here. When we got to, after Vietnam, 46-7%. Here it's only 57%. Then all the bailouts happen, crisis happens, and the money supply crashes. And so this number goes higher. We have more debt relative to money. And it looks like it's still trending up. Again, this is not a chart where I can give you some predictive power to the future. We can only sort of ask the question, where's the trend going? What might it mean for me? Because you kind of tempt fate in both directions, right? Here, for example, the United States had been deficit spending a lot. But because the Federal Reserve had also been buying a lot of this debt, didn't seem like maybe it was a big deal to have more money relative to debt. And, this ratio becomes an all-time low. That switches around. A couple other things happened here, right? We have the petrodollar. United States trying to export its dollars around the world. And so this kind of switches to where we have more debt relative to the M3 money supply. And the M3 money supply in this case is only United States money. Keep that in mind. It's not really money it's not including the euro dollar, unfortunately. It would probably be a little bit more interesting if I could get the euro dollar supply, but I just can't. I can't get it at this point. But anyway, it's total United States debt versus basically total United States liquidity or broad money supply. So in 1995, not much happened. It was obviously Clinton years and Soviet Union had fallen. Things were looking kind of bright. Actually, this was the dawn of the World Wide Web. And it's not like a major, Asian crisis, Russian crisis happened in late 90s. But at this point, it wasn't like there was a major crisis or anything. But what Wall Street decided to do was, even though we're at a 1-to-1 relationship here of debt to money supply, Wall Street said we can have more money. Okay. And that more money eventually came to a point, just like it's kind of here where it's a point that's high. I thought about doing the inverse of this, having the money supply versus the debt. But because because the debt kind of seems to be it's the asset for a lot of money. I decided to have the debt as the numerator, right? So basically, um, I mean, obviously, you can see the indications, obviously, but when more money is growing faster than debt, Wall Street's creating money faster than the government is taking on debt, right? You have more leverage in the system. I don't know. Maybe I could have switched it the other way, but so it looks more like this, where we get in a very levered situation. This number is higher, but it seemed better to me to do it this way, because you'd have to turn it into a multiple in that point. So it's basically, it's 2 to 1, right? It's getting close to 2 to 1. $2 that Wall Street has created versus $1 that the Treasury has created. I don't know. I seem to like this percentage better, but point is, the Treasury is 57% of the money supply here. And now the Treasury decides to get into the monetization game and creates a lot more debt, and then the Federal Reserve is buying that debt, and on we go back to having more debt per dollars. One other thing here that is also interesting is, right, in terms of crises, right, it doesn't seem like crises hit when this thing goes up. It seems like crises hit when this thing goes down. Okay, so went down here, right, and then even here, which again they were trying to normalize still. They were trying to have less. When I say they, I mean it's sort of the entire system. The United States Federal Reserve, of course, drives the money supply, but other players partake in it. But it was even coming down here. It went pretty sharply down from being at 100% in September 2018 down to 90% just on the eve of the COVID crisis. But then, of course, the COVID crisis reverses that trend. And it was a crisis. It was an economic crisis, although, as always, hurting Main Street more than Wall Street. You have a lot of money printing and bailing out and all the rest. But the point is, if we were going to give this indicator anything about crises, it's more when it's going lower than when it's going higher. All right. So what is it doing right now? It's still going higher. But again, is this completely predictable of having a crisis or not having a crisis? It's hard to say. I think particularly because if you look at the grand scheme of the money supply, this is just so out of whack. This piece in particular. It's the largest portion of the Federal Reserve's balance sheet that is liquid. It's the bank reserve portion, right? Plus a little bit of alt cash. That is just so huge compared to the rest of the monetary system that you just get this low bar, which, okay, we can just tell ourselves we're in a new normal and then just look at this for what it is, right? Too much M3 liquidity in the system here. People were scurrying for those bank reserves. The repo rate spiked in September 2019. And then, of course, the bailouts crashed this thing lower. But obviously, when it's leaking higher, it's an oxymoron, isn't it? When it's sort of slowly edging higher, it's a danger, right? So it is doing that. It's doing that here. But then, as we know, they just usually at the first sign of trouble, usually they'll step in and add more liquidity. So they push this line down more, and interest rates are also pushed down further. The point of showing you these charts is it's just, like I've always been saying, I've followed a lot of newsletters over the years. giving people a lot of my hard-earned dollars or sats now. And I've learned some things, but mostly, you kind of manufacture the idea of a crisis when really the status quo can go on for a lot longer. And that's what I'm trying to do with these charts, is just to show you that, look, if you think a crisis is around the corner, this is the same thing the newsletter writers were saying all through here. And did they predict the global financial crisis? Well, it's possible Peter Schiff did. But plenty of other newsletter writers were saying, well, just buy gold, all the way back in the 80s when gold was $800 an ounce. Then it went down to $200 an ounce for 20 years. And it's another reason why I don't think any of these factors actually are the driving factor in liquidity for Bitcoin. You know, this number, all right, so debt versus the money supply was only at 60% in in the depths of, well, the depths of the global financial crisis, I guess we're here, but on the eve of the financial crisis here, and also on the birth of Bitcoin. Bitcoin started here. But is this number elevated because of Bitcoin and people's desire for Bitcoin? Not really at all. It's elevated because the United States government has tried to borrow more than it earns in taxes, and it keeps borrowing more than it earns in taxes, or even more than Wall Street can financialize. And so this number is trending higher with debt. Now, again, has that lined up with crises in the past? Actually, no. This was a relatively mild time in United States history. In fact, a turning point when the World Wide Web was born, and you could do so much online compared to what you had to do here. Speaking of paper newsletters. But my point is that they just do what they're going to do. You nor I have control over it. And at this point, I think it has nothing to do with Bitcoin, actually. I think it has more to do with typical everyday politics that seem polarized, that seem crazy. But, here during the Vietnam War, and as these presidential or party congresses, conventions were happening in the 60s, there were major riots. Still trying to get rid of Jim Crow laws, at this point in the United States history. And if we had to say anything about a crisis, it happens more when this line is going lower than higher. All right, so when there's more money relative to debt, not less. Now there's more debt relative to money. And for that, you got to go here, right? So this is all the money in the world. I'll be updating my base money series here very soon for the quarter. But $11 trillion roughly of all the money in the world, that's gold, silver, fiat money that's not backed by said gold or silver. And right now, this thing goes through May, we got $43 trillion worth. This will change slightly with when I update my exhibit, but I don't think it's going to change by much. Might even be lower. If we compare this to Bitcoin, which started out very much smaller than this at the beginning, this turns into almost a complete straight line, the green. And Bitcoin has this nice, beautiful power arc that we see. This is just monthly market cap, all right? And then I do a more rigorous daily price times coins expectation in the future. So this pushes it out about 5 more years than I said originally when I was talking to Danny about this on what Bitcoin did. But, I think it could be 5 years out and even 50 trillion more out when it crosses. But that's, again, trying to predict 20 years in the future right now is obviously a fool's errand. We know that it's going up. We know that it's going to be adopted. But the point is, even if you try to run all the voodoo numbers on the money supply, like I'm doing here, versus debt, you try to think about it. The driver of this black line is not, it's actually not what Trump is doing or Powell or Christine Lagarde. It's what people around the world are doing to the Bitcoin network as they get exposed to it, as they adopt it, as they think about it, as they hold their own keys or use multi-sig. The power relationship itself between Bitcoin and time is much stronger than anything else I think we can draw for any other financial system like this or like this. You know, again, how did we know that it was the top in April 2008 at 116x total money in the United States divided by total Fed liabilities? How do we know it was not going to go to 125x or 130x? Of course, nobody knew. But that happened to be the number. Fine. How do we know that this isn't going to stay, you know, between a range of 8.5x and 15x or whatever for another 15 years? Just the fact that Ben Bernanke created all this liquidity in zombie banks doesn't mean that it's driving the world towards Bitcoin. That's just a more organic thing that happens on its own. I know it's part of the Bitcoin genesis story, that Bitcoin was kind of born in the crisis. But as we know, or people that have been following this long enough, it's been happening well longer than since 2008, right? It's going the cypherpunks in the 90s, and you can look at Merkle trees and cryptography tech back to the 70s. It's way longer of a process than just financial markets of the global financial crisis. Again, my point being, this is why we're very, very lucky to have Bitcoin, because this is a very comfortable trend. For anybody that's found Bitcoin, that has found the beauty of Bitcoin, this is an extremely comfortable trend that's clearly growing faster than the world-based money. Even though world-based money grows at a constant, which means a strong, continuous year-on-year exponential growth, Bitcoin does not. Bitcoin's rate of growth decreases, as I always talk about. It decreases every day, even, but it's a strong rate of growth here. So this rate of reduction is way less compared to the exponential growth, and that's how you can visualize it. All right, so you can show the Bitcoin dominance now on linear, right-hand side. You don't see much because my face is in the middle, but it says Bitcoin dominance highlighting this axis right there. You see it down here. We get to 100%, according to this, somewhere like 2043. And I have no way of knowing how long this is really going to take, but whereas before I was thinking 100, 110 trillion around 2038, now it looks like 150 trillion, which is even more conservative, right? Even more. It's even better for us all to get in early while this thing gets adopted. And again, even when you get to 100% here, that's only 50-50 relative to all the other money that's been created or mined in the world. Central bank money and money that's been mined literally in mines, gold and silver mines. That's the green line. So it doesn't mean that we're going to see hyper-Bitcoinization or global adoption. It's possible that the SAT denomination occurs somewhere here between 50 and 100 trillion, because it's hard for anybody to ignore Bitcoin when Bitcoin's a $50 trillion asset, half the size of the traditional financial system, which is in gold and silver's case, been around for 6,000 years of civilization plus, 50 years of pure financialization of, 60 years, I guess. No, 55 years. 55 years of pure financialization of the fiat monetary base. Perhaps we get into a SAT denominated Bitcoin standard somewhere here before they reach parity, or perhaps not. I honestly do not know. All I know is this is a way better trend to look at than, say, this. Here we're trying to make sense of, fiat-based debt versus fiat-based money. It's linear. It's one-to-one relationship, roughly. But that one-to-one can fall as low as 0.5. It can be a little bit over 1, which is happening now for the first time in history. But who's to say this can't go up to 1.5 debt to money? You look at everything that happened with the Doge team, whether you agree with their tactics or not. I happen to not agree with them. I think you could have done it more civilly, better for the country in the United States with actual, like multiple people from multiple sides of the aisle, maybe some judges, maybe, some non-federal employees. I don't know. Just try to be truly bipartisan, which it is a bipartisan issue to decrease the debt. Anyway, the debt's still growing. We can look at other charts. I'll pull up the other chart just to show you. Same thing I was showing yesterday, but that's still growing, maybe a bit slower than it was before. But as far as I can tell, the relationship is still holding there. And even though everybody says they want to decrease the debt, it still increases. This period right here was what you would call a very bipartisan, productive government, where the debt was going down relative to the money supply. And you see this little small cresting here was Clinton finally balancing the budget after 8 years in office. He did it for a couple terms, and the debt's basically not growing. And of course, we put this on, as I talked about yesterday. This already goes out till May now, right? So it's now up to 36.2 trillion versus the end of the year, which is, it's about the same. So again, as I said before, whether you like it or not, and I tend to not like it, the way that they were behaving, the Doge team, but they have, at least according to here, slowed down the growth of the debt. We'll see how it plays out for the rest of the year, because you can slow down the treasury auction, but maybe need to pay more fiscally later. We'll see. Elon himself says, I was not a fan of this big, beautiful bill after all the work that we did in Doge. So, point is, even though they say it's a bipartisan thing to cut the debt, it also seems to be a bipartisan thing to just naturally raise the debt, no matter what country you're in. And then that takes us back to this chart. All right, I've been talking a lot. It's already been 45 minutes. If you guys have any questions, I can draw some other charts, or, that can be it for today. But Geo said something interesting yesterday. It's like, is the chart draw the news, or the news draw the chart, roughly. Like I said, Bloomberg, CNBC, they're going to try to tell you why the price of oil popped $10 this morning or something. I have no interest in that. More interested in seeing the long-term trends. And the point is, even when you look at the longest of term trends, like it's not an immediate pattern. You could go through a whole lifetime, half a lifetime, whatever. You can you can be born to your midlife crisis and it takes a full cycle here. Did you really learn anything about United States economics, or did you just see that, debt can be as low as 50 cents per $1 of money supplied and as high as $1 debt per the money supply? These things can go on a lot longer than we think. So focus on the trends that matter, like this one, where even though the stuff's going to grow, gold's going to grow in dollar value, silver, dollars and euros and yen themselves, this is all included in this line. This is just sort of the natural state of things. So right now we're at, where do we finish for June? May. 4.9%. 4.9% is the real Bitcoin dominance index. Okay, we've been as high as 5.1, 5.1. 5.1 was the top. So we're higher in January than we are now. Although, again, this is tentative January figures. I still got to update, but I'll be updating through March here. Alec and I just talked to Anthony Scaramucci yesterday. He said, I asked him if Bitcoin had finally become like a staple commodity where you just think of it like gold or oil or even copper, like it's kind of important, but it's also not important. It's part of the daily story, but you don't really think about it as much. Oops. Lost my mic there. And he said, come back to me in 2035, right? And I think even that is as good a time as any where we can see we're already getting, at that point, 2035, we're getting to 50% of global money. We might not be there yet at 5%, but the trend is really clear. So that's how I'm looking at these sort of big picture ideas, even when, really motivated or drugged up Silicon Valley types try to say they can cut $2 trillion of the deficit. Maybe they can, maybe they can't. Foreigners have a play here, right? Foreigners are down 10 percentage points compared to what they used to be as far as owning government paper. Central bank as well is down 10 percentage points. They were 28%, now they're 17%. And the last thing I'll say is, the United States monetary system has been trademarked with sort of bad monetary regulation and government regulation. So Lincoln required northern banks to own United States government bonds here. That's a distortion that really hasn't gone away. And it's not like we ever had a free banking system. Even here, there was just a lot of government intervention, and banks react to that, to those requirements. You know, the Federal Reserve can start out holding nothing of United States government debt here, 1 to 0.1%, 0.9% at the beginning, and then jump up and jump. And here's where I was talking about Vietnam, right? It was a high. The Fed owned 15, 18% of Treasury debt in 1975, and then it came back down for 20 more years. Really 30 years, I mean, until the crisis. And then back up. So they can remain irrational longer than you have capital. I think it's very difficult to speculate in these types of markets based on the fundamentals. I'm sure that if you study, you know, like trading wicks and drawing lines on TradingView, people can make money there, but full disclosure, that's not what I'm doing. Just try to look at the overall trend. And I do think this is the best way to compare Bitcoin to the overall trend. Fifteen, 20 more years seems like a good timeline, right? Bitcoin's been around for a little over 15 years. If you feel like you've missed the boat on any of this stuff, don't worry. It's just getting started. To me, it's crystal clear that, let's go here. It's crystal clear that, you know, if you're exponentially growing, it's going to grow like this for the green. And for Bitcoin, if you're growing like a power function, it's going to grow like this for the black. And it's pretty fast growth if you look at that on linear scale. So it took us 15 years to get to $2 trillion. All right. To get to 2 trillion more, it's only going to take 2 more years. That's the way to be thinking about this. And 2 trillion more on that, on top of that. Year and a half, whatever it is. All right, guys, I think I will leave it there unless anybody has any other comments from any of the channels we are streaming to. Keep letting me know if you like these or if you want to see different charts in the comments, and I will try to oblige. Thanks for watching. Have a good day.